Hey Sage Seeds, and welcome to another value validation. This is a value investor channel, and my priority is to show you as transparently as possible what my value investment research process is like. By the end of this video, you will be an expert in this company's financials and almost definitely have a strong opinion about where the valuation is. This fintech is called STNE, currently sitting at a just over $3 billion market cap. It is one of the largest companies in the Russell 2000 index. Today I have a couple of different sources that we're going to look at before getting to the juicy annual report form 20F in this case. But this website, Financial Visualizations FinViz, luckily they do paint things green or red. Here on the right, I'm seeing lots of green in the performance section. A lot of times as value investors, we have all sorts of opportunities flashing ahead of us, and it can be difficult to prioritize. Well, here we have a stock that is moving right now. It is still down according to the 1 year ago, but year to date, it's up by over 50%, which is a little crazy if you have been paying attention this year to date. Definitely some appetite for this stock, STNE. We see the forward PE is green, 7.3. That would be quite low, especially for a fintech, but the PE right now is negative. And that's kind of validated by these red numbers right here, the return on assets, return on equity, and return on investment, all negative, yet it's expected, and we know that because of the forward PE, it's expected to start making money within the next 12 months. Flipping these red numbers to green numbers, hopefully. Compounding that risk is the fact that here, debt to equity, long-term debt, more debt than equity within the company's balance sheet right now. I'll let you in on a little secret. This being one of the more promising Brazilian companies right now. In the Brazilian market, it's not that unusual to have a little bit more debt. FinViz here, putting it in red because it's comparing it to predominantly US companies. I mean, here you can see it's being compared to PayPal, Block Inc., JP Morgan Chase. I mean, yeah, if you're comparing to JP Morgan Chase, most Brazilian fintechs are going to look like they have a little bit more debt than they should. By the way, if you are interested in JP Morgan Chase or PayPal, both of those value validations are up on the channel. And so scrolling up here, this is the main reason a lot of people come to FinViz in the first place, is they have these nice, really nice charts, daily candles going all the way back to summer last year, July last year. There's been a pretty clear and wide downward channel here, and most of the performance year to date has come from the fact that we started the year dipping slightly below this channel, really threatening to kind of enter a free fall as far as the price is concerned. Instead, right here, January 14th, January 13th-ish, this now looks like it has commenced a brand new ascending wedge, ascending triangle, ascending flag, whatever you want to call it. From a technical perspective, and the reason I'm choosing to show you this now, if this company truly is undervalued at current prices, we have a new substantial group of investors that's been pushing this stock all year that has just push the price outside of the channel where the previous group of investors very clearly had a hold of it. This new group of investors might even overlap with this old group of investors, but this is exactly what it should look like in theory if the market for STNE is being handed over from a pessimistic group to a significantly less pessimistic group. And I am recording this video a little bit before it comes out. I gotta edit and stuff, but April 21st is the day that I am recording this, just breaking out of this channel right now. By the time this video comes out, perhaps some of you guys will be actually seeing more of STNE on people's radars. So great, that's the setup. Let's start looking into two additional resources, then the annual report. I'm going to try to keep this video nice and tight. I'm relatively new to YouTube. Please let me know what tips I should take away in order to make these videos even more valuable, even more of a resource for anyone interested in STNE.
This video is intended for educational purposes. Opinions made by me or the Sage Seeds AI are not investment advice.
So here we have from Zacks Equity Research posted on the official NASDAQ website comparing STNE, STNE, to Paycor, which is another fintech. We are definitely not going to read the entire article. In fact, if anyone's reading the Zacks article, most of this is AI generated. So we're going to skip most of it. But here, this paragraph, this is a juicy set of paragraphs right here. STNE currently has a forward PE ratio of 9.6. Now hold up, we just saw at FinViz, as of April 21st, forward PA ratio is 7.3. So let me scroll back up here. This came out March 26. And compared to March 26, which is right here, the price has actually increased. So the increasing price should be raising the PE ratio, not lowering it. The fact that we have a lower ratio today than we did when this article came out means that earnings have been being revised upwards. And this is a second hint that is telling me to prioritize this company right now. So now we have an article from January 13th, 2025, posted on Investopedia's page, which, you know, I love Investopedia, by the way. This is where I first started learning investing almost 20 years ago. And they've hired fact checkers, journalists, like a man named Nathan Reef. Thank you for writing this, Nathan Reef. Investopedia is winning in my book. Very high quality lately. But here they have an article, Why Did Berkshire Hathaway Invest in StoneCo? And I am going to link this in the comments. Encourage you to read the whole thing. I encourage you to read the whole thing if you want, but I am going to pick and choose to get the main point out of this before we move on. Berkshire Hathaway announced a sizable investment in the Brazilian fintech company StoneCo in October 2018, 6.5 years ago. Based in Sao Paulo, but officially headquartered in the Cayman Islands. StoneCo employs more than 7,000 people. Its goal is to utilize the most advanced technological capabilities in electronic payments. Key takeaways, love these. The two founders of StoneCo, Andre Street and Eduardo Pontes, worked for over a decade in the electronic payment and payment processing field in Brazil before launching StoneCo in 2012. StoneCo is actually their second payment-related startup, so lots of experience on these guys. 6 years into the company's life, Berkshire Hathaway announced plans to purchase a large share of the Brazilian company's shares. In fact, after IPO, I think Berkshire Hathaway owned their usual 10 to 11% of the outstanding shares. As of 2024, StoneCo had over 4 million active clients. They're probably aiming more to medium-sized businesses in Brazil, perhaps even small mom-and-pop businesses in Brazil. There's definitely not 4 million large conglomerates in Sao Paulo, as far as I know. And I also know that StoneCo very much is a commercial banking business. This is where it gets really interesting for us. In January 2025, StoneCo's market cap was less than $2.5 billion, very different than the peak market cap that it reached during the pandemic of nearly $26 billion, more than 10 times higher. After its initial investment in 2018, the StoneCo position was largely left untouched. Really, it was a mainstay in the kind of exploratory part of the portfolio. A lot of people think it was Todd Combs that actually made this position, although of course Berkshire never explicitly reveals who makes what decision. But it was in early 2024. It took them about the first 4 months of the year, if I'm not mistaken, that Berkshire was selling all of its shares in StoneCo. Wouldn't surprise me if that's actually why the price has been plummeting for the last couple of years. And going back to this chart of the last almost year, at this point, August, July of 2024, Berkshire was officially completely out of StoneCo. But this large channel, it would not surprise me if it is people following Warren Buffett that are always a couple months lagging behind his what his portfolio is doing at Berkshire Hathaway. I think this is very likely Berkshire Hathaway fanboys that just continue to notice, then sell their shares. And that is exactly the sort of thing that could lead to such a clear, distinguishable downward channel. So digging through Berkshire Hathaway's discarded pile very much is the sort of thing I would like to do as a kind of explicitly aiming to be a value investor person. With this setup in mind, we can now officially pull up the US SEC's Form 20F, StoneCo Limited, registered in the jurisdiction of the Cayman Islands. The first thing I want to do is come to the appendix. We're going to go to the financial statements listed in the back. And here at the income statement, for those of you new to these, they do go from right to left. Well, scrolling down to the net income, right here, you can see that Finvis is actually a little bit out of date here, which is understandable. This is a part of the Russell 2000, and it's not even an American company. But last year's annual report had already reported a full year profit of more than $1 billion. But actually, if we scroll up, oh, that could be the explanation, is this income statement is in Brazilian real. So that's why the numbers look quite different. That's okay. Before we keep looking at a bunch of BRL currency numbers, this is what the Brazilian real has been doing relative to the US dollar over the last, this is 1 year, falling by a little over 10% in the last year. It does mean that all the numbers we are saying are 10% less valuable than they would have been when they were published. That's something, but we probably don't have to worry about it too much, but it's always good to check. Zooming in now on the cash flow statement, I'm going to get laser focused on what is the most interesting changes in the business so that we don't have to worry about most of these numbers and rows. And the significant differences are something here from 2.5 billion to less than 100 million. It's called the fair value adjustment in financial instruments at FVPL. That does seem to be investment related, so we'll look at this note. And then a little bit lower down from 1.5 billion to 2.7 billion. Interest income received. If you've been following along with my financial services walkthroughs and validations, you might be learning that all financial companies either make money from fees or money from interest. This is evidence, and we definitely want to look in a little bit deeper, that StoneCo might actually be making its profit on the interest margin side. Both these notes are in the 22 section, 22.1 and 22.4, so let's just go straight to note 22. And here we are, note 22, other disclosures, great. But 22.1, non-cash operating activities, once again, we see FVPL. However, now this section is telling us to go to note 6.3b. And so now I've taken us to note 6.3 called short and long-term investments. I don't see the word FVPL anywhere. The only thing I see is equity securities, a little bit smaller than I was expecting. It actually looks teeny tiny compared to this row up here, Brazilian sovereign bonds. On the cash flow statement side, FVPL seemed to be having a significant billions of reais impact in just 1 year. But we realized that FVPL is not an entity, or I realized, maybe some of you were smart enough to see this right away. FVPL actually is an acronym that stands for fair value of equities, profit or loss. And FVPL is the acronym for the performance of StoneCo's investment portfolio. So what we actually need to do is look here, assets at FVPL. What's going on here is that the FVPL portfolio actually made a June 2021 investment in a company called Banco Inter S.A. The cash flow statement was recognizing a gain from that investment. Using this to now come back up to the short and long-term investments, StoneCo has been trying to get its business centered around being a large investor. It looks like in other Brazilian banks and in Brazilian sovereign bonds right now, but they've been using the money that their core payments processing business does in order to try to become an investor. When we bring this back to the consolidated statement of cash flows and remind ourselves that it was this fair value adjustment in financial instruments at FVPL that started this whole little investigation, we can see that a couple years ago, StoneCo was actually making billions of dollars, billions of reais through its investment portfolio. But as of the latest year, that one investment in Banco Inter was teeny tiny compared to a couple years ago. This tells me that the people working at StoneCo, in terms of their cash allocation strategy, they've already done a whole round of creating their own investment portfolio, and it went decently well for them. They might be very likely to do that again, which makes me want to look up buybacks. Better thing to look up is share repurchase. They do have a repurchase program, but I'm going to skip this first paragraph. The second paragraph is more important. As of the date of this annual report, we have not repurchased any shares, but right at the end of 2023, Board of Directors approved the second in the company's history, share repurchase program of up to 300,000 real. 300 million real. Okay, that makes a lot more sense. At which point in early November 2023, the company used most of that 300 million real. I was saying real, wasn't I? Sorry, real. To repurchase shares. That actually is probably what triggered Berkshire Hathaway to sell off its shares, is that they could sell directly to the company. Nice. As soon as they used that up on November 9th, 4 days later, they made a third share repurchase program, the third in the company's entire history. This time, instead of 300 million, they're able to purchase up to 1 billion reais, more than 3xing their largest repurchase program in history. And going back to this currency conversion chart, we know the company has about a $3 billion market cap right now. 1 billion reais is equivalent to about 170 million, between 150 and 200 million, meaning that these repurchase programs are actually getting quite meaningful. This latest one would represent about 8 to 10% of the entire company's market cap, especially if they were buying last year when the price was even lower than it is right now. And so once again, returning to the cash flow statement, looking at this row that interested me right at the beginning, what we have learned is that this company's cash allocation strategy is very confident, very much seeing itself as smart investors. After making billions of reais during 2021 and 2022, this very large decrease, very noticeable decrease from more than 1.1 billion to less than 100 million billion is not because the company stopped seeing opportunities or stopped thinking that they could invest. It's because they actually decided to put a lot of their investments in share repurchases all at once in this year. Well, that's kind of the best case scenario here for me. I didn't know what was going on here. I just wanted an explanation. And the explanation being that this company is also able to calculate its own intrinsic value and decide that it's a good investment to make in its own shares. Those are several things that just give me additional confidence as a potential investor in this business. So there we got the first major thing. Now, the second major thing, this is where we're going to get into the actual operating and profit margins of the company's core business. Definitely stick around, because if you have not decided whether you like this company or not yet, an analysis of its interest margin might be the thing that makes or breaks your decision. Here is the note in the appendix 22.4, interest income received. And even better news than we expected, interest income received on accounts payable to clients. This is its core set of products that it's receiving interest income in, is nearly 6 billion after being 4.5 billion the year prior and less than 2.5 billion 2 years prior. One thing to keep an eye on, though, is that the 2023 margin taken by dividing 2.7 by 5.9 is clearly lower than the 2021 margin taken by getting 1.5 divided by 2.2. I guess the professional in me should pull out a calculator and do this, so I'll do that now. Pull up a calculator off screen. 2023, it's a 45% margin, but back in 2021, we had a 68% margin. So going from 68% interest margin to a 45% interest margin is substantial. We're making a little bit less than twice as much in final interest income. So maybe that's just part of the nature of scaling up. But where some context might be helpful is that even at 45% interest margin is still really darn high. 68% would have been borderline illegal in most countries. For some context, most of the major US banks fight for net interest margin between 8 to 15%. The rapid reduction is probably expected because these levels are still really, really high, but it is enough of a decrease for me to want to try to see if the management is acknowledging it at all in the rest of the annual report. And as I'm looking through the management's business overview, apologies I kind of went really fast through it, but I'll give you some of the highlights. StoneCo sees itself closer to a MasterCard or Visa than a traditional commercial bank. Now, their first products, as far as I can tell, were commercial banking products, but it also offers digital cards or credit cards. These revolving loans that these credit cards represent have higher interest rates. That's part of the high interest margin equation. Now, the second part of the interest margin equation is the costs, which I'm about to get into here. But then there's a third pillar, which is a little bit more difficult to quantify, which is that StoneCo, maybe I'll show you a graphic that they included. StoneCo thinks it has a whole suite of platform. Basically, anything that you as a medium to small business would need, StoneCo offers. It's not just credit. It's also fraud and security. It's also data management in a cloud platform. It's also customer relationship management in sales. It's also not just having a bank account with Stone, but managing all of your bank accounts through the UI that Stone offers. It also has client services, logistics planning. It also helps you price your product, whatever that product is. And it looks like they're even trying to expand into marketing, but haven't quite gotten there yet. But so the Stone brand combined with its other brands is such a octopus type product that will suck you in all these many different ways that there's a very high switch cost. If you're not using the Stone credit card, you're not getting a lot of these satellite benefits, which a lot of people might really benefit from. You could see that different businesses might have completely different relationships and deep relationships with these unified platforms, as Stone calls them. And so that's a very important piece of where the high interest margin is coming from, is that people are accepting relatively expensive credit cards because it's just one part of a huge network of products, and there are high switch costs. And so the high net interest margin very much related to this setup that they have here. Very powerful switch costs that they've been developing, in my opinion. But of course, when talking about margins, there's also the cost side of the equation, which is just as interesting. Here they're explaining that the main costs in these credit card type businesses are called customer support, solving clients' issues as fast as possible, sustaining satisfaction. And here's where we really realize that Stone is a modern fintech in the truest sense of the word. They have a range of apps, online portals, and just general self-service tools that actually allow clients to resolve most issues by themselves according to their own preference without needing to have all the infrastructure that other, even companies like Visa and MasterCard, if I'm being completely honest. I love those companies. Also check out my walkthroughs on Visa if you haven't already. As amazing as those companies are, and those are very high margin businesses, StoneCo, being younger, seems very far ahead in terms of being self-service first. But if that weren't enough, this bullet point, servicing through bots, could explain that it's not just as good as the best in the US, it's probably better because Brazil is a market that they call highly conversational, which is kind of funny to me. But what it means is that a significant number of the clients actually resolve issues through WhatsApp or chat messages. People don't call on the phone. This allows for scalable data sets, which have allowed their chatbot team, yes, this company, this modern fintech has a whole chatbot team, to create centralized in-house technology for natural language processing and natural language understanding that is directly integrated into that big suite of tools that I showed. And so you're not just getting a really high quality chatbot, maybe up there with some of the best in the world in this domain, but you're also getting the exact same specialized chatbot if you have a fraud and security problem, if you have a cloud software problem, if you have a sales funnel problem. You're getting a consistent level of customer support. That is insanely good position to be in 2025, as it allows customer support to scale up according to processing costs instead of scaling up according to call centers and data centers and all the typical things you would need to set up. I mean, this just overall reduces the cost to serve. When they do need to get one of their customer support live humans involved, they're actually called enchanters, which I think is great. Part of the AI tools, skipping down here a little bit, enchanters are only invoked after this chatbot process, which means that the AI chatbots provide the quote-unquote enchanters with short summaries in the client's history books, making these enchanters so efficient that in 2023, 89% of calls were picked up by a live human within 10 seconds. 10 seconds. But despite that insanely efficient number, here StoneCo genuinely believes in this sentence there is still plenty of room to gain productivity using AI tools. And so the benefits of having such an advanced chatbot customer support model and being centralized and consistent is already reaping rewards while this company is still continuing to scale up. And remember, all of this feeds into a higher margin than you would get in most businesses. And so back at the cash flow statement, remember these numbers are not dollars, they're in Brazilian real. But StoneCo reaching a point where it is becoming profitable. Some brokerages and platforms like Finviz that we saw at the beginning still consider this to have a negative PE, consider StoneCo to not be a profitable company yet. But the analyst estimates are pretty clear. Everyone expects this company to be profitable imminently. And moving over to NASDAQ, StoneCo's current schedule as of April 21st when I'm recording this is that it's going to release its 2024 annual report on May 8th. 2025. This should be approximately 1 week after I release this video. So if you saw this straight away, good on you. If you didn't, it's okay. Markets always move slower than you expect. Well, right now, the expectation is that on this day, PE ratio will be positive. The company will officially be listed as a profitable company according to everyone's screeners and all this other stuff. Finviz will probably update as well. But remember, those are just expectations. And we need to make a decision of how much we think this company is worth ourselves. Currently, it's selling for less than 4 billion, almost 3 billion US dollars. And it's probably going to make something like 300 million to 500 million US dollars by the end of 2025 in pure profit with a net interest margin that is going to be aiming in the high double digits. Now, of course, these are just the simplest, most expectations, just taking the analysts at their word. StoneCo is extremely related to the pulse and vibrancy of the Brazilian domestic economy and the Brazilian export-import economy. Now, I want all of you guys to have your opinions. Share them in the comments. Tell me what you think about this. That's why I'm presenting this information in this forum, is to really get your opinions on it. But I think this is becoming a brand. Now, unfortunately, I'm not Brazilian. Hopefully you guys can find some Brazilians and tell me if this is actually becoming a brand or not. But I'm getting the sense that as a software company, StoneCo is creating this ecosystem for merchants and businesses that puts it right up there with some CRM companies like Salesforce, but probably even more so. You know, those of you following the channel might have seen a walkthrough I did for a company named Dave Incorporated. That company was a value validation where I was very much not convinced by Dave's business model. I saw what they were going for, respected what they were going through for even, but that's a US-based company that had a couple data breach problems that really were mishandled, in my opinion. Feel free to check out that video if that sounds interesting to you. There's a big brown teddy bear on the thumbnail last I checked. Should be distinguishable from the other thumbnails, I hope. But StoneCo is kind of giving me the impression that it's similar to Dave in ambition, but executing in all the right ways. I mean, this is almost like every place where, no offense to Dave employees and Dave management, but every place where Dave kind of stumbled or doubted, StoneCo just seems super comfortable making, honestly, aggressive decisions, shutting down your investment portfolio when it's been doing so well in order to start doing substantially sized stock repurchase programs. That just takes a lot of guts to do when you're the management of a young fintech. And so I hope the management of StoneCo continues to do what they think is right, and hopefully they stick around for a while as well. StoneCo just needs to keep executing decently well for the foreseeable future, and it might genuinely develop network and switch cost effects that could carry this into a very, very nice scale size business. And it's already on that pathway, in my opinion. So I'm definitely keeping an eye on this, trying to watch it not stumble. But if it does, I'm not going to fight it. I'm going to watch what happens. But make your own decisions. Don't listen to random people on YouTube like me. I'm not doing this to give you guys advice. I'm doing this to show you guys my process and hopefully inspire your own energy, your own efforts in this value investment domain. If this was helpful at all, if this was a level of transparency that you're not used to seeing, that is what I'm going for. I hope you can appreciate it. It also helps tremendously if you like and subscribe.